First, let's start with the basics. Mortgage refinancing is the process of replacing your existing mortgage with a new one. The new loan could offer better terms such as a lower interest rate, shorter loan term, or access to home equity. Refinancing can be a great way to save money or adjust your loan to better suit your current financial situation. But before jumping into a refinance, you need to know if it makes financial sense for you. That's where the break-even point comes in. Step 1. What is the break-even point? The break-even point is the number of months it will take for you to recover the costs of refinancing based on the savings you get from a lower interest rate or a better loan term. In simpler terms, it's how long it will take you to recoup the upfront costs of refinancing through the money you save on your monthly mortgage payments. Calculating the break-even point is a critical part of determining whether refinancing is worth it. Because if you don't plan on staying in your home long enough to break even, refinancing might not be the best option for you. Step 2. Understanding APR, annual percentage rate. One of the most important factors in refinancing is understanding the APR, or annual percentage rate. The APR is not just your interest rate. It includes the cost of borrowing, including the interest rate, as well as any fees or charges you incur as part of the loan. This means the APR gives you a more comprehensive view of the true cost of your loan over the life of the mortgage. For example, if your lender offers you a loan with a low interest rate but charges high fees, the APR will reflect that. When comparing mortgage offers, you should always look at the APR, not just the interest rate, because it includes all of the costs associated with the loan. A lower APR generally means a better deal for you, but be sure to consider the full picture. Step 3. What are points? Next, let's talk about points. Points are fees you pay upfront in exchange for a lower interest rate on your loan. This is also known as buying down the rate. 1 point is equal to 1 of the total loan amount. So if you're refinancing a $200,000 mortgage, 1 point would cost you $2,000. Paying for points can be a good way to lower your monthly payment and reduce the overall cost of your loan in the long term. However, it increases your upfront costs, and this is where the break-even calculator comes into play. When you pay for points, you'll need to calculate how many months it will take for the savings from your lower interest rate to offset the initial cost of the points. If you plan to stay in the home for a long time, buying down your rate with points can be beneficial. But if you're planning to sell or refinance again in a few years, paying for points might not be worth it. Step 4. Fees and closing costs. Now, let's discuss the fees and closing costs associated with refinancing. When you refinance your mortgage, you're essentially taking out a new loan. And just like when you bought your home, you'll have to pay closing costs. These costs can include application fees, title insurance, appraisal fees, attorney fees, recording fees, and more, depending on your lender and the size of your loan. Closing costs can range from 2 to 5 of the loan amount. So for a $200,000 loan, closing costs could be anywhere from $4,000 to $10,000. It's important to factor these fees into your break-even calculation because they'll affect how long it will take to recoup the total cost of refinancing. Some lenders might offer to roll closing costs into the loan, but this will increase your loan balance and your monthly payments, and may even result in higher interest payments over time. Step 5. Calculating the break-even point. Now that you understand the key factors involved, let's walk through how to calculate the break-even point. To do this, you'll need to know your total refinancing costs, which include any points you pay, and the total closing costs. Next, calculate how much you'll save each month with your new mortgage. This is the difference between your old monthly payment and your new, lower payment. Once you have both numbers, Simply divide the total costs of refinancing by the amount you save each month. For example, if you pay $5,000 in closing costs and points and your new monthly payment is $200 less than your old payment, it will take you 25 months to break even. This means that after 25 months, you'll have recouped the costs of refinancing, and any savings after that point will be pure profit. If you plan to stay in your home for longer than 25 months, refinancing is a smart move, but if you plan to move or sell before then, refinancing might not pay off. Step 6. Other considerations when refinancing. There are other factors to consider when refinancing your mortgage that might affect your decision. For example, if you're currently in an adjustable rate mortgage, refinancing to fixed-rate mortgage can provide stability and predictability, especially if interest rates are expected to rise in the future. Another consideration is the term of the loan. You may choose to refinance into a shorter loan term, such as a 15-year mortgage, to pay off your loan faster and save on interest over the life of the loan. While this will increase your monthly payment, it can result in significant savings in interest over time. On the other hand, you might choose to refinance into a longer loan term to lower your monthly payments, especially if you're experiencing financial strain. But keep in mind that this will result in paying more interest over the long term. Step 7. Is refinancing right for you? At this point, you might be wondering if refinancing is right for you. It ultimately depends on your financial situation and long-term goals. If you plan on staying in your home for many years and can afford the upfront costs, refinancing may offer significant savings, especially if you can lock in a lower interest rate. But if you plan to sell your home in the next few years, refinancing might not be the best option, especially if you are not able to break even within that time frame. Before making a final decision, be sure to consider your current mortgage rate, the potential savings from refinancing, the total costs involved, and how long you plan to stay in your home. Step 8. Conclusion. To wrap things up, mortgage refinancing in 2026 can be an excellent way to save money or adjust your mortgage to better fit your financial goals. But it's important to fully understand the costs involved, including the APR, points, fees, and closing costs, and to calculate your break-even point to determine if refinancing is the right choice for you. By using a break-even calculator and carefully considering all of the factors, you can make an informed decision that will benefit you in the long run. Remember that refinancing is a big decision, and it's always a good idea to consult with a financial professional to make sure you're making the best choice for your unique situation. Thank you for watching this in-depth guide on mortgage refinancing. We hope you now have a better understanding of how to use a break-even calculator, how to factor in APR, points, fees, and closing costs, and how to decide whether refinancing is the right move for you. Make sure to check out our other videos for more tips and strategies on personal finance. And as always, if you have any questions, feel free to leave them in the comments below. We'll be happy to help.